What's holding you back from starting or growing your business into what it can be? Well, if you're watching this, it's not a lack of information. What you're about to see is all you need to get motivated to start making waves. Do It for a Living details the journey of today's true players in their own words. Find out how they broke out so you can too. The time is now. The time is always now. Welcome to another episode of the Do It for a Living podcast. I'm Kevin. Today, Richard is gone. He's on vacation, but we have a guest with us who is an accountant. His name is Jerry Cecco of Cecco and Associates. He's here to teach us all about accounting for your shop. So this is a very poorly understood topic for most people, and I'm hoping he can help us clear up a lot of different topics and I guess concepts with how to handle your books and how to do everything as a small business owner. So Jerry, how are you doing today?
Doing great. Thanks for having me.
Yeah, and what I'm excited about is you're a car guy.
Big time.
Which is how I got a hold of you. So
yes,
Terry Fair is our mutual friend,
Yep.
And I think you have done work for him in the past.
Yep.
But go ahead and first tell us, what got you in accounting, what got you into racing. Just kind of give us a background of yourself.
Right. I've been a car person before I was an accounting person.
Okay.
So sitting in my brother's 69 Camaro when he was coming home really late from the bar.
Okay.
This was I was in elementary school, listening to the Beach Boys in his 69 Camaro.
Okay.
So I was done. From that point forward, I knew I was a car guy.
Okay.
Then I got into accounting in high school. Like everybody sees it for the first time. This made sense to me. You know, anything to do with money sounds good to me.
Yep.
That's where the money is. So after that, I got into cars probably, it was 96 is when I went to Sears Point for the first time.
Okay.
As a spectator.
Okay.
Never knew this industry even existed.
Yeah.
Until I went there and I saw amateurs on the racetrack going, where do I sign up for this?
Yeah.
So 6 months later, I think I bought a Mustang Cobra, got on, was it Streets of Willow for the very first time, which is in Southern California.
Okay.
And
is that where you're from, California area?
Well, we lived in the Bay Area. Well,
Okay.
Originally born and raised in Edmonton.
Okay.
Moved to California. We were in California. We lived in California for 20 some years before I moved to Texas.
Gotcha.
Yeah. So, so I fell in love with tracking and HPDE events and all that.
Yep.
When I was in the Bay Area, ran at Laguna, Sears Point, Buttonwillow, all those tracks around in California. So,
Very fun.
Oh, yeah.
And I know you do it a lot around here, and you were doing it in a Corvette around here, right? Is that
Yes.
correct?
Yeah.
Okay.
Yeah. So after many Mustangs in my past, and I had a Cadillac there for a while, a friend of mine said, hey, why don't you try a Corvette? You might like that. It takes less modifications.
Right.
So I got into that. My first one was a 12 C6 Z06, and the one I have right now is a C7 Z06. Love it. I've looked at other cars, and they just come up pale in comparison.
Okay.
So, yeah, I love it.
And then the accounting side of things,
Yes.
before we came in here, I asked the question, you're a CPA? And the answer was no.
No, correct.
So explain that to us first. So
Sure.
I always thought all accountants were CPAs, but clearly that is not the case, right?
Right. Yeah, CPA means Certified Public Accountant.
Mhm.
And typically, like all accountants, you go to school. CPAs have to graduate with an accounting degree. Then they go back and, very similar to an attorney, and take an exam to get their certification.
Okay.
And like I said, the biggest difference between myself, a non-CPA, and a CPA is they can sign off on financial statements. So now there's a level of, I don't want to say trust, but someone they can go after if there is fraud found in those numbers.
Gotcha. Okay.
Certain institutions require, audited or CPA signed off financials, and many don't.
Okay.
So depending upon your business side, like, the big accounting most shops I've run into, nobody needs a CPA. Nobody needs the extra expense, because to get your CPA, you need to have a bond insurance and rigmarole.
Okay.
I go to my clients going, now I can be a CPA and I can charge you an extra $100 an hour. Does that sound good to you? No one has said yes to that.
Okay. So likely then my CPA may not even be, they just might be accountants then.
Right.
And I just refer to them as a CPA.
Right.
Okay.
It's like Kleenex, so like it's a generic term. But when it comes to tax returns, again, more of a specialized industry, which I don't do, but they take the work that I do and create the tax returns. And again, many tax people are CPAs, many are not. Again, with to get that type of work done.
Gotcha.
Yeah,
Okay.
yeah.
Okay. So when you first sit down with like a small business or a shop, like you're looking for the P&L as kind of the ultimate, like, here's the health of the business sort of thing, right? That's kind of the goal.
That's one of them. Let's work backwards. A P&L on the balance sheet is needed for tax returns.
Yes.
And a lot of, you have to have that, period. And that has to happen only once a year.
Yes.
A lot of the businesses that I worked with want to see those type of reports more than once a year.
Okay.
And then that's where you start customizing to the business. Do you want to see it once a week, once a quarter, twice a year? It all depends how often they want to see the numbers. Okay. And my forte over the years is taking that need of financial numbers and then building some custom reports. Going, okay, you need to take a look at the P&L, but maybe you want to see some custom reports on a weekly or monthly basis that focuses in on subsections of the P&L to give you the data you're looking for to make the decisions to hire or not, or buy more equipment or move, or those big decisions that requires a commitment in the future for money.
Gotcha. Okay. Yeah. So if you don't understand the P&L,
right. Okay.
Like, what is as me as a business, if I don't understand what I'm looking at, how does that hurt me?
Trying to making the P&L work for each business will give them the focus in on, okay, what kind of sales, where are they coming from?
Okay.
Is it parts? Is it service? Is it a blend?
Yes.
Is it one-offs? Is it used parts? I mean, there's a variety of different income sources.
Okay.
So trying to figure out where the bulk of the revenue is coming from is important.
Yes.
Because most of the time, you want to commit resources, your time, employees, make where the flame is the biggest. So,
right. Okay.
So if you're profitable in selling used parts, for example, then you'll probably want to spend time in that area.
Yeah.
Or if you have a lot of service business, you want to hire mechanics to do more of the service work.
Okay.
Yeah.
Okay. And then before we get too deep into the P&L,
sure.
This is a topic that I have to help people out with a lot too, because my software kind of splits the two, but cash versus accrual.
Sure.
Small shops, I see a lot of people defaulting to accrual, whereas I think cash helps certain types of businesses. But can you explain the difference between the two of them?
A cash business is typically what happens through the bank account.
Yeah.
So if you have revenue when the check clears, and not any day before that, and you have expenses when your checks clear, and not a day before that. So you might have a check in your hand for $20,000, but if you don't deposit it, you have no revenue.
Yes.
That revenue is not realized because it hasn't cleared your bank.
Okay.
All right. So many small businesses, myself included, is cash basis.
Yeah.
Because it's simple. It's a simple business. Cash comes in, I spend it.
Yep.
Cash doesn't come in, I don't spend it.
Right. Yeah.
A lot of shops can start that way, but as they grow, they realize that they have to go accrual because their time to make an invoice happen is not the same day. You bring in a car in on Tuesday, you buy some parts, you put some labor in it, you buy some more parts, you might have to go back to the customer to get an additional deposit. So you can't run, because you're going to run an accounting system to track all of that.
Yeah.
And maybe do some progressive billing.
Yep.
And sales taxes that are related to that.
Yeah.
And then close off the invoice.
Yep.
And every shop that I have ever bumped into, needs to and does focus in on the profitability of every invoice.
Yes.
Even if it's just, an online order, somebody buys parts for X amount of dollars, you make 20% or 10%, and away it goes.
Okay.
Longer type of sales, cars here for a couple of months or a couple of weeks, couple of months. I've seen a couple of years too, that you can't wait to the very last day to create an invoice. The shop will be out of business.
That's right. That's right.
So you go into progressive billing.
Yeah. And so is there a difference between progressive billing and accrual accounting? Is there differences on that?
Well, the progressive billing is like the invoicing method that you would use.
Yes.
So for example, if you have 100,000, you estimate let's do a car bill for $100,000.
Yeah.
And you're going to have the car for 4 months.
Yep.
$25,000 a month.
Yep.
You're going to bill out at roughly. Yep. So every month you're going to have a $25,000 sale, and then and costs of that sale, labor, parts, whatever.
Mm-hmm.
So you don't have a $100,000 sale at the very last day. You have four $25,000
progress billing,
progressive.
Right. Yep.
So A, you can recover your costs, and B, you don't shock the customer,
right?
Where he doesn't walk away from the car going, "I'm not going to pay $100,000." So you're improving your cash flow. You're not waiting to the very last day, to get your profits, as well as recoup all the costs for parts and labor and all the rest.
Okay, so what I see happen in this $100,000 job example, this is one that I see frequently is people put that entire invoice into QuickBooks.
Yep.
And so now they have a $100,000 invoice in QuickBooks, and then they want to take a $20,000 deposit on it.
Yeah.
But when you're in accrual basis, QuickBooks says, hey, you owe sales tax on a $100,000 project.
Yes.
And is that something that you can how do you split? I mean, obviously the answer to that is make smaller invoices and split it out for 4 months.
Yes.
But is that how accrual works then, essentially?
Right. So the day that the invoice hits the accounting software,
all the taxes are due.
That is what is typically known as the day of recognition of the sale.
Okay.
And sales taxes is calculated on that day.
Yeah.
Right. And then is due in that period of time. So most places, like in Texas, has a monthly sales tax. So from the 1st to the 31st, whatever sales taxes that are on invoices, whether they're collected or not, are due roughly 15 days, 10 days after that period.
Yeah.
So I always tell shop owners is, if you're not going to collect all that money on the 31st, wait a day.
Or don't put it on an invoice, essentially.
Well, no. I mean, you have to, if you're going to close out an invoice, right? Mm-hmm. And you're going to close out an invoice on the 31st of the month, but the customer doesn't show up to the 5th.
I gotcha.
You are going to pay sales tax 10 days versus another, So close out the invoice when the customer is here with his credit card or clear check, that sort of thing.
Okay.
Because it just makes, for example, just the sales tax alone, it makes that easier because you've got the money to pay the sales tax.
Okay. But for cash basis, you don't have to worry about that at all. You just, once the invoice has been paid, then it hits the books. Is that correct?
That's right. But most shops, because they're running inventory and then they want to take a look at labor analysis, will probably shy away from running a cash-based business.
Okay.
Now, and I can't remember off the top of my head if Texas sales tax procedure accepts cash as a basis, because I think you have to be accrual. You got to put a star in that, and you probably have to check their website out.
Okay.
Most of the business that I run into, they invoice the time of sale and they collect and they file.
That's right. That's right. Yeah. It just gets really confusing when you have like the restoration or $100,000-$200,000 project where it's taking you a year to do, and you're billing them every 2 weeks.
Right.
So it works out fine when our software kind of acts as an intermediary where you manage the project in the project management software, and then we just slice out a monthly bill and put it into QuickBooks for your accounting. So then you can treat that. You could do cash or accrual at that point because it's just a one invoice and you're getting paid on it immediately. Right. And then the project as a whole is held within the project management software. So it's good to do it that way, and it's not going to screw up your sales tax or anything.
Right. And when it comes to sales tax, you never want to get into an audit, and if you ever do, there's a reason, and they're going to be like, you're kind of guilty until proven innocent.
Right.
So what you want to do is have best practices, because just like every other entity on the planet, they want their money.
That's right.
They don't want their money in June when they think they need it in April.
Yep.
Right. So that's why it's nice to have segmented invoices going, we did this work and we did an invoice.
Okay.
And here's the sales tax for it.
Perfect.
The project is still open, but we do progressive billing.
Okay.
Yeah, because you're collecting and paying the state.
Yes.
Right?
As you've collected
as you
money
go
on the job.
along. Right.
Okay.
It's not that you're going to collect $50,000 in sales tax at the very end.
Okay. And then, so you mentioned parts. Does carrying inventory affect like accrual or cash basis at all, or is that kind of separate?
The difference there is most accounting can do cash or accrual, like QuickBooks can do reporting on both at the same time. The emphasis there is when you do your tax return, it asks you whether you're cash or accrual.
Right.
Now, when you're running your business week to week, month to month, you could flip back both, between the two. But most businesses who have inventory of significant value and labor costs of significant value will be in an accrual system.
Okay.
Because when you have yourself, you don't have to track your own costs. But as soon as you have one more employee, most owners say, all right, I'm paying you 40 hours a week. Am I billing 30, 40, 20?
That's right.
So, and to do that type of analysis, you almost have to go to an accrual because there's time spent every day the employee is here, but you're only paying him twice a week. So on a cash basis, you'll have an expense on that payday, but the expenses are incurred daily.
Right.
So that's why it's simple to start off cash, but most businesses, as they grow, move away from that because they want to start analyzing profitability of labor, of parts.
As they go.
Right.
Yeah.
Right.
Yeah. So like your billable time each day and that sort of thing.
Right.
Okay.
Yeah.
Okay. What happens if with either one of these accounting systems, and this happens to every shop I've met, what happens when somebody just doesn't pay the bill? Like with accrual, obviously the invoice hits the books, but they don't pay you. How do you deal with that? What's the recommendation, or what's the better way to do it in that case?
Well, I'm going to stay away from the legal side of it.
Obviously.
Yeah. So on the accounting side is if you're in the current, even if you're outside the current period, if you have paid, like you should have, in a accrual system, paid the sales tax to the state. Like, let's say, for example, you created the invoice in June, you paid the sales tax in July for that invoice, but the guy still hasn't paid, you haven't paid. So there comes a date where you're like, he ain't paying. So what you need to do is create a credit memo, which is the opposite of an invoice.
Okay.
So now you're crediting back the sales of parts and labor and sales tax.
Yeah.
So on that day that you create the credit memo, which is the opposite of an invoice, is now you have a credit sales tax. So when you file your sales tax on that period, you're going to pay them all the sales tax you collected less the credit from the credit memo that you've paid in a previous month.
Okay. So it's not as simple as just deleting the invoice out of there.
No, never do that. Because what happens there is that if it's a prior closed period for sales tax and you delete it, you've already paid the state 20, 30, 200, 300, whatever the number is. Yeah. And if you delete it, then your sales numbers don't agree to what you filed in a previous period. So if you ever get audited, they're going, wait, your sales were X and your system says Y.
Okay.
Right?
Okay.
So so unless the period is still open, I almost never recommend deleting invoices. Yeah. It's, if it's an error of the same period, the period is still open, you may want to zero it out. I always recommend doing a credit invoice so you're not deleting things.
Okay. But if it were a cash basis, then it really wouldn't matter because it's not on you're not paying tax on it until it's actually been paid, right? So if it goes unpaid, it's not affecting your previous month's sales tax, essentially, right?
Yeah. Again, I don't know if Texas filings you can do cash. I need to look into that.
Okay. Yeah. So
because again, most of the businesses that I worked with are working accrual.
Okay.
Right.
Yeah.
So that's actually something to check out with
because I do mine as cash and I pay my sales tax based on cash, I assume. I don't really know what the difference is. Yeah. It's just a report in QuickBooks I just pull up the sales tax and tells me what I owe, right?
Right.
So,
Right. You're right. So
okay, so let's go ahead and look at the anatomy of the P&L, right? So let's kind of start from scratch. If you're a typical performance shop, at the top, that's your revenue, right?
Yeah.
So it kind of explained to me what's a good way of setting that up, so that way when you look at the end of the year with a good P&L, you have it broken down with what a shop should be looking for.
Right. Again, I always look. I try to work backwards. So at the end of the year, you need to file a Schedule C, which is your tax return that everybody has to file, and there's a format there that needs to be filled in. So I always start from that, saying whatever you do customization wise, it needs to filter down so you can create as your Schedule C.
Okay.
So that's going to have like sales, returns, COGS, and your standard type of rent and office supplies and labor type of thing. So from that, you're going to explode it out, saying, all right, the type of sales that we have is labor, parts, customization.
Okay.
So every shop is going to be different, and it depends upon like sales first, like what type of a volume of sales, like many transactions, or dollar amounts, like
big transactions.
Well, yeah, exactly. So if you sell used parts for $200, you don't need a custom built account. But if you're doing customization and it's $300,000 a month, you may want to have some subcategories like, is it import or domestic or whatever, source where the customer came from, whether there's commissions that need to be calculated on some of these sales or not.
Yeah.
So typically when the dollars are big, that's where the focus needs to be.
And on breaking that down.
Yeah.
So on your P&L on the top, top of the revenues, it'd be like labor, customization, state inspections, alignments, or building roll cages or whatever it might be.
Right. You can have your sales as big as you want, and many accounting systems are able to expand it out and do a collapse. So you can do like parts, labor, custom.
Okay. So
and blow it out even more if you want to have more level of detail depending upon your focus.
And in QuickBooks, when you're setting up those accounts, those are revenue accounts.
Yes.
And then QuickBooks lets you set up subcategories in there. Okay.
Yeah. So you can set up, subcategory till you can really dig down pretty deep.
Okay.
Yeah.
Okay.
Yeah.
All right. Okay. So the next one is parts. So parts have a cost to them in addition to the revenue from selling them, right? So explain that the cost of goods sold is typically, it's in the top for the revenue, but it's in the top section of your P&L, right?
Right. So the very top lines are your revenue.
Yep.
Then your next chunk of lines is your cost of goods or cost of services sold.
Okay.
So COGS or costs. So those are the things where, again, the inventory that you used to make that sale happen. So, for example, you do an oil change, you're going to have oil filter, some supplies, and that's about it. I don't think there's no cost of air to put the air in the tires.
Right.
That's
nitrogen, right?
Oh, sorry, nitrogen. Right. So the parts you use for that one particular sale is your COGS.
Okay.
Your cost of goods sold.
Okay. Right. And then that lets you, on the top section, lets you show the profit of the parts, or the gross profit, right? What should be your revenue from selling it minus the cost of the part you're selling.
Yes.
And then that gives you the profit of the part, essentially, right?
Right. So if you have a parts sale, then you'll have a parts COGS.
Okay.
So you sold a part for $100, it costs you $50 to buy it. The difference is your gross profit on parts.
Okay.
Right.
And then you said the costs, costs of services.
Yeah.
Now, is that not typically just your payroll?
Yes. And again, it gets into every shop is a little different.
Okay.
So what I've showed some shop owners over the years is your mechanics, right? You're depending upon the agreement per mechanic, is you might pay them 40 hours a week.
Yeah.
All right. You're here, you get paid. Okay. Other shops are, I pay you for every labor dollar or labor hour you charge.
Yeah.
So if you bill out 20 hours a week, I pay you 20.
That's like a general repair dealership type of work, right?
Exactly.
Yeah,
exactly.
Book pay. Yeah.
Right. So and other shops are kind of a blend.
Okay.
What I've seen many times is employees are in for 40 hours a week. So typically that is an expense, right? Because they're there no matter what.
Yeah.
Right. And then there is a credit in the expense. This is how I show people to do it, saying, all right, of the 40 hours a week that they worked, they got billed out maybe 25 hours.
Okay.
Right. So that would be a credit in the expense. And then that amount would be a cost of services sold.
Oh, okay.
Yeah.
Interesting.
Right.
Okay.
Because you're going to have your labor sale, say $1,000 for at $100 an hour for 10 hours.
Okay.
But you pay your mechanic $30 an hour for whatever amount of hours.
Sure.
Right. So then you have a gross profit on your services.
Okay. So that's really telling you what the actual service cost you to perform.
Exactly.
But as a shop as a whole, when
Yeah.
if you have like a parts manager who's handing the technicians all their parts,
Right.
they do contribute to the overall profitability of the shop.
Yes.
But they are not a direct cost to the services you did, essentially, right?
Right. So the parts director or
Or
person
manager or whatever overhead people.
Yeah, and that's where it gets into, how far down, small of a pie do you want to cut into?
Okay.
Right? So some people in larger organizations, they'll try to figure out kind of a equation where they'll break down expenses to be charged into COGS, but you're now breaking down, you're breaking the toothpick down into very small parts.
Okay.
And it only makes sense to do that if those dollars are pretty significant.
Okay.
Like for example, if you have a significant support staff.
Yeah. Top heavy business or whatever.
Right. Let's say, for example, you have 5 of these guys running 25 mechanics. Well, then you're talking some serious dollars. So you'll want to figure out a way to put some or all of those managers as a cost of the goods sold, if that's all they do.
Yeah.
But if they also do other things like clean up the shop and other things that are not directly related to any particular sale, that's where you need to really define how they do it. And some of it might be billable, some of it not.
Sure.
So it is and every business or every shop that I've seen is unique. Right? So many don't have that, some do. So you got to figure out, okay, maybe half his time is COGS, cost of services sold.
Yeah.
And other time he's doing other things.
Okay.
So.
Now, what if a business is doing, and so you talked about breaking down the revenue of like labor and parts by kind of like, hey, this is fabrication, this is, alignments or whatever. What if it's like almost a completely different business entity, but within the same organization? So for example, I do, mostly service work, but we have a website. And so I sell parts in the storefront, but I sell parts on the website.
Perfect.
How would you tell people to break that up on their P&L so that way they can, show, hey, the e-commerce store is making money, or all the profit is coming from the service side, we should just shut down the e-commerce? Like, how do you break that down?
Right. A lot of it depends upon what type of systems you're running, whether it's QuickBooks or maybe like a POS, like an online service.
Let's just
system.
assume basically everybody uses QuickBooks.
Right. I know that QuickBooks has like secondary a way to charge both sales and expenses. And what I mean by that is something called classes or location.
Okay. Yeah. Classes I've heard of.
Oh, good. Perfect. Class. So you could set up a class called online.
Okay.
So as you're going through your sales, that's an online sale, and the other sale is not. So you can run a P&L run it by class where blank is blank, and then and it'll show you all your online sales, both on the sales and then the expenses. So there is secondary ways of doing that.
Okay.
Other ways you can achieve that is the online sales. You probably have Shopify or another interface doing that.
Yeah.
So what you could do is you could bring those sales into QuickBooks as its own income or sales and cost of sales. Say, okay, Shopify means online.
Yeah.
So that will be its own line item separate from what the shop does.
Okay. And this is where, when I've looked at this before, this is where it gets confusing, is because if you just do a default, like a I have a part that I sell on my website and in store.
Yeah. Oh, so it could be sold both places.
Both ways.
Yeah.
So if you put that on an invoice,
Yeah.
the part has its own account.
Yes.
But when you put it into a class, it separates it it makes separate columns in a P&L, right? There's like different
Right.
revenue centers, I guess is what it is. Is that kind of how it works?
It's it won't take away from what it is, which is a part sale and a part cost. What you're doing is putting a secondary tag on it.
Mm-hmm.
So it would be a part sale. And then if it's an online, you say, yeah, it's in the online division or the online department.
Okay.
So if you could substitute class for department, same thing. It was sold through the online way.
Okay.
Yeah.
Good. Okay. So then gross profit. Explain to us the importance of that number and how that, reflects the shop's health.
What I tell people is gross profit pays for your race tires.
All right.
No profit, no tires.
Right.
So what gross profit is basically the profit from one individual sale.
Okay.
Right. So you buy something for $100, you sell it for $200, you have $100 profit.
Okay.
It's as simple as that. The same thing with labor. You pay your mechanic $30 an hour, you bill them out at $120. The difference is your profit.
Okay.
Yeah.
And when you're looking at you've mentioned this already a couple times, like a job profitability. Like you said most businesses look at each job individually and kind of look to see what are some things they could be looking for to make sure they're reaching, like what kind of margins should they be looking for on average? I mean, I'm guessing this is different for every type of business, but
and it's true. It's every business is different when it comes to margins, and a lot of that is controlled. For example, your rent here in Texas is significantly less, I hope, than it is in California.
Oh, that's probably true.
Right?
Yeah.
So the margins that you would run in California would be significantly higher to cover the costs of rent, health insurance, whatever, right? I'm sure there's some costs. So what a business should do on margins, it's almost down to their individual thumbprint. For example, the owner says, I need to pull $100,000 out of the business every year. Well, that has to be put in to the margin to make sure there's enough.
Sure.
Or I need to supply race tires to my car.
Right.
So we got to have the margin, the leftover profits to pay for all the extra things.
So, and this is a dig at Terry here. Your term for buying race tires has to come from Terry. I think that's all he ever does is buy tires, wheels and tires.
But he also wins them too.
Yeah.
So he's much better than I.
Okay. Okay. So then now you're talking. We know the gross margin is basically the profit off of a job.
Right. Gross profit. Yeah.
Or gross profit is the profit off of job, but that's not the profit the business sees at the end of the year because you now have expenses underneath that, right? So that's the next section down on the P&L. So explain to us expenses and what is kind of all included in that.
Yeah. So once again, working off the Schedule C from the tax return, you're going to see things like office supplies, rent, health insurance, wages, computer supplies, computer software, internet, website, you name it. The list can get pretty long.
Professional fees. That's one of them, right?
There you go. Legal and professional. Right. So those are kind of expenses that whether you have a significant increase or decrease in sales volume, it's there. Mm-hmm. Rent's not going to change if you have 10 invoices or no invoice.
Sure.
Rent is rent kind of thing.
Yeah.
Right.
Okay. So when you break all those down, one of those is going to be payroll.
Yep.
Right.
Yep.
Where does the owner take money? Should they be taking out a payroll or just at the bottom line, the net profit at the end of the year is their money or a combination of both?
Right. Again, depending on how the company is organized on the legal sense.
Okay.
If it is a simple business like a non-corporate entity.
LLC?
Yeah, for example, yeah. The bottom line profits from the P&L is basically the owner's wages.
Sure. Okay.
Right? All of that falls into the companies, and then the owner can take it or not take it.
Yeah.
Right? When you have a corporate entity.
Like an S corp or C corp.
Exactly.
Okay.
The owner can or not put a salary in there.
Okay.
So, for example, if the company has a corporate company has $1 million bottom line, right, before the salary of the owner, he can put his salary becomes an expense to the entity. Remember, a corporation is its own
entity.
thing,
Yeah.
entity.
Yeah.
The owner is over here. The entity is over here.
Okay.
So the owner is now an expense.
Yep.
His salary is an expense to the entity, the corporation entity.
Okay.
Right. After that, the profits of the entity of the corporation now fall into whoever the owners are. There may be one, there may be a dozen.
Yeah.
Or
shareholders.
Exactly,
right?
shareholders.
Yeah.
Or the profits will just stay in the company, in the bank account for future
use.
Okay. Exactly.
And when you're on the corporation side, then if you hold the money, you don't pay tax on it until you disperse it. Is that kind of how that works? I have no idea how that works.
Yeah. Again, once we get into the type of entities and profits and distributions, that's where the tax person comes in.
Okay.
So typically, the taxes on a corporation for the owner, if he's an employee and gets paid through payroll, right, he'll have his salary and deductions and all those, whether it's an owner or an employee, all the payroll is handled the same way because, again,
a separate entity.
The owner is an employee of the entity.
Sure.
He just happens to also own it.
Okay.
Right.
Whereas with an LLC,
right,
because it's essentially under my name or whoever's name,
right,
and then that entity, which is them and the company, at the end is all their money,
right,
to either pay taxes on or spend it on more tires.
Exactly. Race tires. Yeah. So again, at the most LLC businesses that I've seen, owners don't typically take a salary because or pay themselves a salary because then there's taxes on it that need to be paid. It creates an additional expense that once you get to the end of the year, you can't give your salary back if the bottom line is negative. Yeah. So a lot of owners wait and then maybe pay themselves a draw, because a draw is like...
You need to have some money cash flow throughout the year.
Right. And then at the end of the year, the bottom line will be whatever it is, say it's a $500,000 profit. And if the owner says, oh, great, we don't need that, so I will take some or all or whatever, because at the end of the day, it's not a separate entity, it's him.
Yes.
It's the owners as that LLC.
Okay. Give us just a round number. Like you've dealt with shops, automotive businesses. What's decent like net profit for them based on revenue, like a percentage?
There's no...
Zero is not good, right?
Zero is bad. So we want to stay away from that. And negative is worse. It all depends. I've seen shops. It all depends on how you consider yourself successful.
Okay.
There are some shops that are like happy with, a bottom positive line, because they're not there for the Ferrari money, and other guys want the Ferrari money.
Okay.
Right. So, defining a successful bottom line is it's I got to spin it around to each owner. You tell me what a successful business is. Is it making, $1,000 a day or $1 million a month? I don't, you got to tell me.
I would love to make it $1 million a month.
Right. So
it's hard to do on a shop that only does $500,000 a year though, right?
but it's defining the success and then keeping it there.
Okay.
Yeah.
Okay. So really looking at the percentage of net profit is more or less like looking at you as an owner, how much you want to make is the goal.
Right. Yeah. Like for example, if your rent, I'm just going to make up a number, is $20,000 a month, which I would consider high, but it depends upon, again, on the sales volume you're doing.
Sure.
So, but it's a very luxurious helicopter pad at the track kind of expense, then you need to support that expense.
Yeah.
But other shops, that doesn't help me, get this job done. I don't need a $20,000 shop. I just need a $2,000 a month shop.
Okay.
So again, it's how the owner looks at expenses going, oh, I got to have that.
Okay.
So
Okay, so then kind of going into the next section here, like let's generating these numbers. So like bank feeds into QuickBooks, like that's an easy way for, I think, shop owners who are kind of, generally it's like their husband and wife team kind of like trying to do it all. How do the bank feeds kind of help this whole thing? And what do you do with like reconciling? Kind of explain what that whole system is. So
yeah. Well, in the last few years, it's been maybe 10. More than 10 years ago, I was not a fan of QuickBooks Online.
Okay.
I've been using QuickBooks Desktop since the 80s. So that was my sandbox. I just,
you know how to do it, right?
I know how to spin that thing around. And it seemed like every year they were coming out with more and more features. And what happened was it started to fix problems. And then you had time to find other problems. And one of the problems that QuickBooks Online does a really good job at is, since it is an online product and banks are open for communications from their bank into QuickBooks, most of my clients now are QuickBooks Online, where they're downloading, or I'm downloading for them on a daily basis.
Okay.
So when they write a check or whatever, so there's no more, oh yeah, I forgot to tell you about the check I wrote that cleared.
Yeah.
Or all the expenses on a credit card, because a lot of businesses use credit cards.
And those sync to QuickBooks as well.
And they sync to QuickBooks. And you can set up rules in QuickBooks. So when you go to Tire Rack, those are race tires.
Okay, yeah.
Or you go to McDonald's, those are meals. You can set up rules so you don't have to touch them. When there's a charge from McDonald's, that goes to meals. When there's a charge from Tire Rack, that goes to tires. When there's a charge from BP, that goes to gasoline, that sort of thing.
Sure.
So you can set up rules so someone's not going there going, oh, here's McDonald's for the 5th time this month, and I'm charging it to the same place.
Yeah. So and then when you take those syncs and you're trying to reconcile them or assigning them to different accounts. So if I'm buying from, let's say I'm buying from Tire Rack, I can classify those as automatically be cost of goods sold, or is that kind of depending on the product on the invoice? Because they don't. The bank reconciliation does not know what's in the sale. It just knows the amount and the company it's coming from, right?
Right. So the download will have the vendor name, the date, the dollar amount. That's it.
Yeah.
They don't know what it's for.
Yeah.
Again, when you're buying parts for resale, it should, in that perfect world, which we visit often, it should go into inventory.
Yep.
Right. And then from inventory, because you buy the part, you put it on the shelf. And then it could be the next day you take it from the shelf and you put it on someone's car. So at that day where it comes off the shelf and onto someone's car, that's the COGS.
Okay.
Right. So until it's put on the car or sold out the door, it's on your shelf, that's inventory.
Okay, gotcha.
Yeah.
And if you're not tracking inventory, then it's just based strictly off when the part was added to the invoice and then when the part was bought on on an expense, right?
Right. Yeah. So and that's where issues can start, because sometimes, depending upon when you want to close out an invoice and the customer has his credit card in your hand, you're not going to go, hey, did that thing get posted? You want the money.
Right.
So you want to close the sale and you hope that you want to make sure it happens. Now, the download may have not happened when the customer is there waiting to pay off his bill, right? Depending upon who's running your back office.
Yeah.
So that might be happening daily, monthly, weekly, don't know.
Okay.
But you want to be able to close off that sale, get the sale and the COGS and have all that right.
Okay.
So that's why I always recommend to use an inventory, because in that instance, you're going to have a cost of goods sold of the part, and it's going to hit back to inventory before the inventory came in the accounting world.
Okay.
So that's where the reconciliation comes in, going, all right, I sold a part I didn't have on my books, but I had physically because it was on the shelf, obviously.
Yeah.
So, and that's what happens is that many shop owners, when they have the husband and wife duo, she will hit that, or their partner will hit the accounting on the weekend, at night, whatever.
Yeah.
But the sale happens 9 to 5.
Yeah.
So that's when that type of lineup is important to do more often than less.
Okay.
Yeah.
Okay. So purchase orders, how does that play in with I mean, you're saying if you do it inventory or non-inventory, purchase orders I think are super important.
Yes.
And it's a lot of shops I don't think use them at all, or they're just putting it as an expense with the bank reconciliation.
Right.
But the purchase orders are basically, hey, I'm buying this part and putting it in inventory, right?
Yes.
And then it's not actually added to inventory till you make it into an expense or a bill, and then mark it as paid, correct?
Right. Yeah. So the PO is typically an order, right? So that, and again, depending upon the type of entity, when you're a much larger corporation, you'll want to be tracking those because you want to find out, you're buying what, even though before the parts arrive.
Yeah.
But if you're a smaller business, you want to use a PO because you're buying a part not just for the shelf, but maybe for someone's car.
Sure.
Right. So the PO says, yeah, I'm buying some tires for job A.
Yeah.
So it's not for the shelf that one day we will sell to somebody at some time.
Yeah.
It's going on a job. So the PO can do that, tracking the part purchase for a particular job.
Yeah.
Right. Then when so you've made the order, hasn't arrived yet. When it arrives, typically you'll have the bill or a bill of lading or something. And that becomes, all right, now we have it on the shelf.
Yep.
And hopefully the PO and the bill line up. You said you're going to charge me $200, but I got the bill that said $250. What's going on?
Sure.
So hopefully the PO cost and the bill costs are the same as what they quoted you on the phone. And that's a whole other world of things should be the way it should be versus reality.
Yeah. And so this is my experience with this type of industry, at least the size of businesses. It seems to be largely like all the people I buy parts from force me onto their website to buy them. So I'm having to go to their website and I know what parts I need on my invoice for my customer. And then you go to their website and then you add all the parts. And then you add the shipping. And then I have to go back again and I have to add it into my system as a bill or an expense, right? So there's a lot of triple entry. I'm adding it onto a customer's invoice. Then you go in and put it on their website and order it. And then I have to copy it all again. So there's a big disconnects in that. But that's everything seems to be like on demand, I guess. Like it's rare for shops to carry enough inventory to do all that, right? So,
well, just like I said earlier, once you solve certain problems, then other problems come to light. Because what you described, I remember the day where you did all of that over a telephone with a piece of paper and a pencil, right? So what we're doing is accelerating it.
Okay.
So we have solved certain, you're going to a website. 20 years ago, we had no website. We had a parts catalog. And before that, it was, smoke signals. I don't know, but, I know it's somewhat cumbersome, but it's much better than the systems that we had years ago.
Okay.
Yeah.
Okay. And so inventory management, we kind of touched on this already, but a part does not hit your inventory until you mark it as received inside of QuickBooks. Is that correct?
Yeah. Well, when you get the bill in, that's what I would.
Okay.
When the bill hits, because then you know what the real cost is versus the quoted cost.
Sure. And then the way QuickBooks kind of handles that is that part goes into your inventory, and that goes into an account representing the value of the part. How does that work?
Right. So on the balance sheet, there's a line item called inventory. And some businesses will have sub accounts: tire inventory, car parts, body shop parts. They can break it down however they want it, or just inventory. And again, when you're running QuickBooks, you can get reports saying, all right, what did I buy this week? What did I buy this month? Sorted by vendor, sorted by date, sorted by part number, that sort of thing. And then what you want to see also is, so the part comes in for $25, and then when you sell it, there's a negative for $25 when you sell it. So,
on the balance sheet.
Right, on the balance sheet. So in a perfect world, the inventory on a balance sheet will never go to zero, because you're always buying and selling.
Okay.
If it goes to zero, then you're doing it all wrong. But it does need to be reconciled.
Yeah.
And again, I tell owners that at a minimum, you have to do it once a year for tax returns.
Sure. Because the tax man wants to know how much value of inventory you have, which is on the balance sheet, essentially. Right?
Yeah, exactly.
Yeah.
So as well as for the tax return that you file for your business, your federal filings, like you have a P&L, you also have a balance sheet.
Okay.
So things like cash and accounts receivable and inventory.
Okay.
Right. So at a minimum, you need to count your inventory or value your inventory at least on December 31st. And I've told owners, you know, if you know for a fact that you're not going to sell it by December 31st and it's say December 22nd, just wait, because you're going to have it on the books and you're going to have to count it.
Okay.
Versus if you buy it in January, it'll be sold by February. You
don't have to worry about it. So you're saying wait to buy it. And
it's less to count.
Okay, so if you don't need it in the end of December, don't buy it until January.
Right. Because the other thing is when you buy it and it ends up as an inventory item, that's not an expense, but it does take cash out of the business.
Because you're paying it to the tax man.
Right. No.
Oh.
It's money out the door to pay for the part.
Oh, okay.
Right. But you didn't get at the end of the year, you still have the part, but you don't have the profits from the part.
Sure.
So why not, wait a day? Is if, in that funky week between Christmas and New Year's.
Yeah.
That's when I'm the busiest because I'm always talking to owners going, all right, let's count the inventory. Let's evaluate it, take pictures of it.
Yeah.
Put it in the books, make sure it's valued correctly.
Yeah.
So, we can make sure. And I always tell them, if you don't need it, if the customer's not coming in to pay that, because he wants his car for, New Year's Eve.
Yeah.
Don't buy it.
Okay. Because in Texas here, we have property tax.
Right.
And property tax looks at the value of the business and stuff and inventory. And so
It's part of that. Yeah.
You actually have to pay taxes on the products you have on the shelf, right?
Yeah. There's a small, there is
a super small percent, but it is something, right?
It is something. Right.
Yeah.
Right. And, less is better when it comes to that for that period of time.
Yeah. And 2 episodes ago, Richard Fielder, who was a guest who's not here right now, he was telling at Peterbilt, they make semis, right? So Peterbilt, we were talking about the Toyota's like on-demand manufacturing.
Oh, yeah,
and like only having enough inventory to build the stuff you want to build right then and there.
Yep.
And that's the exact reason he said was so that you don't have to pay taxes on it or inventory at all at the end of the year, or at least minimize it as much as you can. Right. So it's lean.
Right. And for years, that was always the promise. And with computerization and high-speed internet, you're able to fix that problem.
Yeah.
But what happens during a pandemic is you have another problem.
Don't have inventory
to build anything.
Because you can't get it, right?
Yeah. You can't get it, right? So what happened during that time, it exposed that efficiency, but you have no inventory. You need inventory to build.
Right.
So then I think a lot of businesses at that time said, all right, well, maybe we do want to carry a little, we should have something. And then the question becomes what? So that was before it was too low. Now it's a different number, and I don't know. And every business is different.
Sure.
So.
Yeah. If you can't make cars in every car you're selling for $100,000, that's a problem, right?
Right. Exactly.
Yep.
Yeah.
Okay. So this one is kind of interesting too. So like the price of parts changes very, very frequently now. Like basically every time I order one. How does that affect like your cost of goods sold? Like your balance sheet and what you should be selling the parts for? Because if every part I buy it for a different price.
Yeah.
How does that change the books?
Yeah, that's an ongoing concern I've seen with many businesses. And again, if you're buying an oil filter, right? One day it's $5, the next day it's $5.05, one it's $4.95. Depending upon how many you do, you're going to calculate kind of a blended cost.
Okay.
And that's one example where you're doing a lot of them.
Yeah.
Right. If you do a lot of oil changes, for example.
Sure.
But if you buy one carbon fiber fender every 6 months, right, you're going to buy it for $100 one day and then $300 the next day. But you're only going to buy it for a particular job.
Yeah.
Right.
Yeah.
Right. So on that type of thing is, you'll want to find out, well, geez, I only spent $100. The real trick is to make sure you're charging the customer the right price.
Well, you see, I've made that mistake so many times. I could have bought a Lamborghini by now.
Because that can get out of and what QuickBooks does, and you get back into more, you step back and get your accounting book out.
Yeah.
There's a thing called FIFO, first in, first out. So the first part you bought is the first part you sell.
Yeah.
Right. So it's like, I don't know, dairy products. You know, you want to sell the oldest one.
Right. Yeah,
You
you
never
don't want
wanna
to
do
have the expired milk sitting on the shelf.
Exactly.
Because that was the last one you put on there is the first one they're taking, right?
Right,
You
right.
push it
You
forward.
push it-
so
right,
yeah.
exactly, right. So that's like first in, first out. And then there's blends of costs where QuickBooks can calculate the cost based upon all the costs that so if you bought the oil filter for $495 and then $505, $550 and costs all over the place, it can assign a blended cost based upon the formula you build into QuickBooks.
Okay.
Yeah. So
Interesting.
QuickBooks has tools to
handle that stuff.
Yeah.
Okay.
Yeah.
Okay. Interesting. I've never seen that part of it, but I don't buy enough oil filters for that to matter. Maybe I do. I don't know.
Yeah, well, and I think in automotive, like for example, tires. I mean, just the other day I went to Tire Rack, and I'm like, when did they go up $80 a tire?
Yeah.
So you almost want to not do blended costs for those one-time special purchases.
Yeah.
Because the prices they go one way, right?
Yep.
So you have to buy it for the
job you're selling it on,
job,
right?
right?
Yeah.
Right.
Mm-hmm.
So that's where inventory might hurt, depending on what kind of inventory you're buying, right?
Yeah.
If you know for a fact that you're going to use the same oil filter for the next 10 years, and the guy comes to you, hey, we got a 50% off, buy all of them,
Yeah.
right? Because you know they don't go bad,
Yeah.
and they're universal. Sure, why not?
Yep.
It's not eggs; they're not going to go bad.
Okay. When should people be doing their inventory count then? Is that kind of once a year thing? Is that the most important time?
Yeah, for a minimum once a year, December 31st, because you need to know that number for your tax return.
Okay.
After that, then it's almost like the fingerprint.
Just to know what your inventories are, so you're not
Exactly.
selling stuff you don't have.
Right,
Okay.
right. So a lot of businesses will do it again once a year, and then the next question is maybe once a quarter,
Okay.
which is every 3 months. And other business going, nah, we've got quite a bit of money on the shelf. And there's a lot of people going in and out, and maybe there's bonuses and there's salary expectations or whatever. There's other things that revolve around inventory, like when you come to car dealerships.
Yeah.
Then they may want to count the inventory on a monthly basis.
Okay.
But I've never heard of anything more frequently than a month.
Okay. Well,
Like
it's
weekly
super
is crazy.
time consuming. So I've worked at in college and high school. I've worked at like Office Max and Staples, and
Yeah.
we would once a year have to count that. It takes forever.
Right.
Yeah, yeah.
Yeah, absolutely.
Okay, so that kind of covers the parts of stuff. No, sorry, one more. Shrinkage. So like damaging stuff getting stolen, maybe even stuff just sitting on a shelf forever and not being able to sell it, and you just trash it. Like, how do you handle that stuff?
So again, things like that come up when you do an inventory.
Yeah.
Right. Because that's when you kind of go, Jesus, we've had this part in forever. It's obsolete.
Yeah.
Or this tire is garbage because it aged out. It's rock hard. You can't sell it. So at that time where you adjust your inventory, it was valued. This tire was valued at $200 when I bought it 3 years ago.
Yeah.
I cannot sell it now. It's garbage.
Yeah.
So you're now reducing the value of your inventory by that purchase, and you are writing it off.
Okay.
Yeah. So typically what will happen is that you will create a journal entry saying, all right, the value of the inventory needs to be this dollar amount because we are throwing things away.
Yeah.
It's missing. Somebody's race tires were used over the weekend, whatever.
Yeah.
So what it shows on the books isn't what's really on the shelf.
Okay.
Sellable items on the shelf.
So when you say a journal entry, you're not doing a sale for
Correct.
this part that you lost,
Right,
and you're not just. I guess technically you are reducing the inventory count by one or whatever it might be, right?
Right. So yeah, you're not selling it because there's no customer.
Yeah.
You're not buying it. You're not returning anything.
Yeah.
And I use the word journal entry as a transaction that's not a sale or a credit memo, or a journal entry is like the end all. It's the type of transaction to fix things.
Okay.
Yeah.
So in QuickBooks, is that in like the banking section thing? Where do you kind of handle the journal entries, or is it off of your balance sheet?
No, it's on the balance sheet. It's in one of the transactions that creating a journal entry is in every accounting system, including QuickBooks.
Okay. Yeah. So but when you're going to expenses, it's not an expense. Like expenses, I always look at it as there's a PO, there's an expense, and then there's a bill.
Yeah.
And they're all, the PO is different, but expense and bill are similar, right? So bill is just one that hasn't been paid, and expense is something that You're just putting in there because you've already bought it,
Right,
right?
right,
Yeah.
right. For example, like an expense would be when you buy gas for your car
Yeah.
and use your credit card.
It's an expense.
It's an expense.
Yeah.
A bill is like, I bought something, I haven't paid for it yet.
Yeah.
Here, accounting, pay this bill on the right date. So, but a journal entry is a transaction that we post into QuickBooks that has no, outside source document.
Okay.
Like for example, if you're calculating amortization on a loan,
Sure.
you're making your payments, but at the end of the year, you need to make sure your balance and your interest paid is what shows on a statement. A lot of guys just say, all right, I'm not going to post 12 individual, get it to the penny. I'll just wait to the end of the year.
Interest payments, just do one big giant interest
A journal
payment.
entry going, okay, what's the balance? The difference is interest done.
Okay.
One journal entry once a year,
Okay.
Okay,
So now that we have a good structured P&L, we've talked about how we build it. How often should a shop owner be looking at this throughout the year to kind of make sure they're on target?
The P&L?
Yeah, or basically, what the numbers that we're looking at. So,
Well, I think most owners look at maybe not the entire P&L, because a P&L will show things like, yeah, I know my payroll's $20,000 a month. Don't need to be reminded of that.
Yeah.
I know my rent's $4,000 a month.
Yep.
So what they should be focusing in on the things that are more varying, like what are the sales this week?
The revenue.
The revenue.
Okay.
Like what are the expenses? Did we buy a lot more of X than we did last week, last month, last quarter? That sort of thing. So you want to look at the deltas.
Okay. And then when we're looking at this, let's say 1 month you have, or you from year to year, you kind of like are slipping on revenue, but maybe your profit is still okay. What are some things that kind of generate these like differences from month to month or year to year? Like, is it just like, hey, my overhead is decreasing because I have less people working for me, or a combination of all? Is there something that you like? Because clearly the opposite is usually the case. You're paying people more every year, right? So
sure.
you're giving them an annual raise.
Yeah.
Your costs go up
Because they're making more revenue for you, right?
or hopefully, right?
Right. Well, yeah, I always look when I start looking at P&Ls, if I have like, a 5-year numbers on a monthly basis, is I always look at what the percentage month over month is, January through December, every month and one for the year, and then every month and once for the year.
Okay.
And you want to see, all right, are the percentages like all over the place? 1 month it's 10%, the next month it's 40%, or is it pretty consistent during the year? So there's not one huge month and one really bad month when it comes to the end.
Okay.
And then you want to look at a period of time going, all right, 3 years ago, our gross profit, right, was 30%, and now it's 40%. Right on.
Yep.
And that might come from not selling more, but selling at a higher price.
Yeah.
And or buying at a lower price.
Sure.
Right.
Okay. Yeah.
Yeah.
So all the things that people think about, but like I feel like a lot of shops just don't consider all this stuff. They don't like consider like, hey, all I have to do is charge more for the parts so I can make more money. Because a lot of it, we're tied, our hands are tied on a lot of products, especially in this industry. Is like, I can't sell wheels for whatever I want because people look online and see the same price for 20% of what I'm buying it for.
Right. Well, and I've always talked to owners like the customers come to you for a reason, so give them that reason.
Okay.
You know that part, rim tire A is so much better than B because I've tested them, right?
Yeah.
So there is value because I do the same thing going, why is this rim $400 and this one's $3,000? Well, there's a reason, right?
Yep.
I don't know what it is, but shop owners
Someone does, right?
Somebody does,
Yeah.
right? So there's value, and I won't buy the $3,000 rim, but someone will.
Yep.
All right. So trying to identify the right customer who has the right budget for the right profit.
Okay. And then, so as a shop owner trying to fix things, because clearly most of us are going to have problems with our books, but fixing things starts with, I feel like a lot of people reach to a bookkeeper. What does a bookkeeper do? How does that differ from what you do?
Oh, okay. I think a bookkeeper is more, get the numbers in the right bucket.
Okay.
Get the numbers in the right bucket. The owner or someone, maybe an accountant, will show the bookkeeper, all right, I want you to do this on a regular basis, on a monthly basis. Bookkeepers don't really typically get into analyzing trends or profitability or opportunity costs, that sort of thing. Where an accountant or controller will look at, we'll see the individual transactions, can see the trees, but also can see the forest.
Okay, this is also a topic that is like probably not fun for you and worse for me is when you have spent a year doing things wrong in your books.
Yeah.
What do you recommend for people fixing stuff, or just at the next year, just wash yourself of the previous, if you've done a poor job of doing it for previous years and you want to start moving forward, what do you recommend for that kind of situation?
It depends what the problem is. My recommendation is if you're going to make a change, you want to make it as quickly as possible.
Okay.
If there's money involved or profits involved. But if you can wait till the end of a month, quarter, year, so then the following year you are no longer doing that. Mm-hmm. Right. So when you look back at financials, we were doing it this way because of but now we're no longer doing that, and that the cutoff date. So sooner the best.
Yeah.
But if you're December 25th and you discover you're doing something, just
wait till
January.
Okay. Okay.
Right. Yeah.
And what are the most common problems you see with businesses' books?
Again, that's kind of a fingerprint type of thing. Inventory.
Yeah, that's a tough one, right?
It can get out of hand really fast.
Yeah.
And then, like you said, they'll look at it going, well, we've had these tires in for 5. Why do we still have these tires here? So once you discover it, then there's questions to be answered. And sometimes shop owners have so many other questions that should be answered sooner.
Yeah.
Like, how am I going to make payroll?
Yeah.
Right. So they're always putting out fires, right?
Yep.
Is what I say sometimes. So it's the fires that you haven't addressed for a while that sometimes can really, won't help in the long term, but they have to be looked at.
Okay.
Yeah.
And then you as an accountant, if someone's approaching you, what are the questions you want to ask them, or that they should be asking you to make sure things are going right?
Well, a lot of it is like, all right, who's buying?
Okay.
Who's doing the buying? Who's closing off the sale?
Okay.
Are they, I think we are, years ago, there was a lot more cash sales.
Yeah.
And non-disclosed cash sales.
Yeah. Under the table stuff. Yeah.
Right. And I think that those days are gone.
Yeah. Like 90% of my sales are credit card now.
Yeah. Because everybody's using a credit card for the points, or they're Zelling or whatever, electronic media payment there is, which is good because that means,
people's
that
books
type
are legit.
Right.
Next man's happy, right?
Exactly. Yeah. Cash is all, So those type of business that had a lot of cash sales, I just don't see them anymore.
Okay. Interesting.
Which is good because that means, you're like, wait, your bottom line is negative a bazillion and you're driving a brand new Ferrari. I'm like, how does that work?
Yeah.
Well, I do a lot of cash business, a lot of cash transactions. And I'm like, okay, don't call me, I'll call you. So yeah, just staying away from things like that, and again, who's handling the sales is a pretty big deal, and who's doing the buying, because that's doing the commitments of things. So getting a handle on that,
okay.
And most businesses, it is the owners or the owner's partner who is doing one of those two, which is that level of trust.
Sure.
Right?
Sure.
Maybe a long-term employee's been there 10 years.
And that's where you hear people like stealing money from the company. It's usually because they're like a management or owner involved and they're just kind of siphoning off the top, right? That's typically where fraud comes from or whatever, right?
Yeah. Well, that's harder to do again when you no longer have cash sales.
Yeah.
You don't put it in your pocket anymore.
It's hard to, yeah.
The temptation is also gone too.
Sure.
Right. So that's a big one. And it's like, all right, for example, you buy tires or oil filters or whatever, you got to make sure if you bought 100 or 20 or whatever, that's what hits the shelf.
Yeah. Yep.
So, and that's that careful balance. You want to have availability to parts, but it's not a, free for all.
Right. Right.
Where you're like, wait, What happened to 20 oil filters? We had 20 oil filters here. Now there's only 5.
Well,
We didn't do 15 oil changes yesterday.
for me, I buy oil in a 55-gallon drum.
Oh,
and,
right,
and
right,
it's like it'll happen once a year. I'll forget to have a drain plug on a new engine, and then you fill it up, and you have 5 quarts in the ground now, and it's like, okay, well, 5 quarts are gone, and then when I go to buy a 55-gallon drum and I look how much sales I had in oil, I'm like, man, I don't even feel like I sold all 55 gallons. Where did it all go? Right? It's not stealing it; it's the shrinkage problem, right?
Right. And that's a perfect example. And what I relate to is the same thing like payroll. Is like you're paying your employee 40 hours. You, as most shop owners would want to do, is let's get as many of those hours billed as possible. Right? You can't go over 40, obviously.
Yeah.
But getting close to 40 is.
Sure.
The happy land. Right?
Yep.
Yeah.
Yep. And that's the whole previous episode I just did, is focusing on the shops getting as close to 100% efficiency as they can. And really, we call it productivity now, because general repair can be over 100% productive because they're doing those book time and finagling, right?
Sure.
But yeah, for anybody doing custom work, your ultimate goal is 100, but I feel like 75 is doing very, very well. So.
Well, the higher the percentage, the better, obviously. And I think just exposing that fact to some shop owners are kind of,
there's 30% efficient?
Yeah,
I'm here for 6 hours and I'm only working 2?
Right. And a lot of once you show that to some shop owners, then they, the focus is now redirected from what their next race car might be to what's going in and, what are the guys doing in the shop?
Yes.
Kind of thing. Right.
Cool. Well, I don't want to take too much of your time. And
great.
I really appreciate you kind of sharing your knowledge and kind of teaching us like what there is to deal with the accounting side of businesses. So thank you very much for taking your time. Also, how can people get a hold of you if they do need help?
Sure. My email address is out there. It's jerrycecco@gmail.com.
Okay.
I've had the same email address for 30 years or whatever it is, whenever Google started. Just reach out to me, send me an email. Say, hey, I've got this question or problem. Pictures are great. If you want to send me a picture, never, ever, ever email me or anyone else your social security number.
Okay.
But just reach out. If you want to do a quick call, just email me with your phone number. I'll give you a call back.
Okay.
Tax season is upon us.
Yeah.
So I'm probably going to be more available after April 15th than before.
Sure. So when you're talking to people to move into a new accountant or get an accountant for the first time, your recommendation is start that as soon as possible, but it's easiest for you after tax season, right? So.
Right. Well, for me right now, because my focus is all the clients I have
currently.
Right. So I want to make sure they're all serviced well. They're all as happy as possible on April 15th.
Yep.
Which sometimes is not. But after that, then April 17th is Budweiser Day, but the 17th will be when I'll probably have a lot more time and, hey, let's talk about it.
Okay. Perfect. Well, thanks again for stopping by and sharing your story.
Yeah, it's been great.
Okay.
Thank you.
Thank you for watching Do It For a Living. You can find out more about this guest, this show, and even details about what we just talked about at our website, doitforaliving.net. Check out the Facebook page, facebook.com/doitforaliving, and tell us who you want to hear from. And if you're running a performance or racing shop, check out My Shop Assist at myshopassist.com. We build shop management software specifically for the motorsports industry. Most importantly, subscribe to the channel. Click subscribe, hit that notification bell, do it now. Seriously, I'll wait. If you're watching on YouTube, the button's right there. If you're listening on a podcast app, hit subscribe there too. When you subscribe, you help us gain momentum and attract more high-level guests. Thank you for watching, and good luck.